The truth is that the period I described, look, if you look at 09 through 21, you had low and declining interest rates thanks to no inflation. You had a healthy economy stimulated by the Fed. You had a paucity of defaults and bankruptcies. You had no real fear. The greatest fear was the fear of missing out. Nobody was afraid of losing money. You had happy asset holders, eager buyers, easy access to capital. So you put that together, that's a pretty glowing period.
What's going on, guys? Hope you're having an absolutely fantastic day. So in this video, we're going to be listening to Howard Marks talking about the 2009 to 2019 period and how it was a period of extreme excess, right? And if you missed the first part of this video where Howard Marks was talking about the economy, interest rates, and also the stock market, there will be a link or whatever it is at the top right. So without further ado, let's get into it.
So we didn't have a boom. Where you had excesses, perhaps were in leverage finance, you know? And so equity investors will lose money and junior debt holders will lose money. I think that's what's going to happen.
So, are you excited, for the, transitioning from a decade where growth did well and value did not, and feels like we're rounding into the perfect opportunity zone for Oaktree?
Well, I don't want to jinx us, but no. But the truth is that the period I described. Look, if you look at 09 through 21, you had low and declining interest rates thanks to no inflation. You had a healthy economy stimulated by the Fed. You had a paucity of defaults and bankruptcies. You had no real fear. The greatest fear was the fear of missing out. Nobody was afraid of losing money. You had happy asset holders, eager buyers, easy access to capital. So you put that together, that's a pretty glowing period. And of course, the trouble is that idyllic periods like that encourage risk-taking. So people push up their LTVs and try to limit their equity, and they.
Let's just take a look at what LTV means. Actually, I don't know, but I think it's something. Yeah, loan to value. Okay, it's something to do with leverage, right? So basically, what Howard Marks is saying here is that period basically encourages people to take on more risk by putting out less equity, right? So maybe instead of last time, let's say you go into real estate, you would put 20% down. Now you put 10% down, right? Because the banks allow you to do it, and also because you feel there is no downside, right? Because you feel it is all upside, right? And if you feel it's all upside, of course you will leverage yourself to the hilt, right?
Become willing to engage in riskier assets, And one of the interesting hallmarks of the last 15 years was, prior to 15 years ago, I think you couldn't issue a bond for a company that lost money. And in the last 15 years, it became possible. Prior to 15 years ago, the private equity industry, for the most part, would not invest in technology or software. And then they said, well, maybe it's okay. And so you have a lot of tech and software that was the subject of LBOs, for which a lot of debt was raised. And these things will be tested. Buffett says it's only when the tide goes out that we find out who was swimming naked. And the tide, we believe the tide will go out. So we're very.
So that's very interesting, right? This he gave this talk April of 24th of April 2023, right? And he says we believe the tide will go out, right? Means he believes that the tide hasn't gone out, right? So even after we've seen this drop, he feels it is inadequate, right? That we haven't seen the last of the market downdraft, right? And also, I just want to take a moment, since I've already paused the video, to talk about what he's talking about, which is very important, right? Those are the hallmarks of you not wanting to invest, right? But of course, you can't sit out this whole 13-year period, right? But then all the irrational exuberance, all the easy liquidity, all this makes deals harder and harder for value investors to find, right? So you can see in this video, even though maybe some of the context is lost, Howard Marks is actually talking about how hard it was for Oaktree to find returns, right? Because I think in the last video or in a future video, I've watched this several times, so I cannot really remember which part it's in, right? But he talks about Oaktree having 22% returns, right? Unlevered. So there was no leverage and they generated 22% returns. And at this point, I think they're generating 11% or 10% or 9% or something like that, right? So you can see obviously a stark difference, right? And that's basically what he's talking about, right? In a competitive environment like this, like everyone's bidding up assets, right? There's a race to the bottom, lowest yields, I don't care. The winner of an auction naturally is actually the one who is willing to pay the most, right? Which means you are willing to generate the least yield on that asset, right? So that's a bit of a understanding to what he's saying, right? So if you're enjoying the video so far, do help me smash up the like button, hit subscribe, and also hit the bell button and press on all, right? So this will really help out the channel. And also watch till the end, right? Because obviously you don't want to miss any important information.
Very optimistic. The 13 years I'm talking about were a tough period. Well, it was a great period for asset owners and borrowers. It was a terrible period for lenders and bargain hunters, which is what we are at Oaktree. That's what we consider ourselves to be. And, you know, the distressed debt funds, 35-year record, gross return of 22% a year, unlevered. Now, if you can make 22% a year on unlevered investments, it gives you a sense for the bargains we were able to secure. That's how you make that kind of money. The value investor, his goal is to buy things for less than they're worth. Makes perfect sense. They're most commendable, right? But the trouble with that is that it requires the cooperation of somebody who's willing to sell an asset for less than they're worth. And that happens.
Okay, and that's a very interesting point that he's bringing up. Because to get a bargain, right, you have to have someone else sell value to you. Basically, someone will have to sell $1 bills to you for 50 cents or 40 cents or 30 cents, right? So if that's the case, why would someone want to sell you that $1 bill for 30 cents or 50 cents or 40 cents, right? So let's listen to Howard Marks on what he has to say about that, right?
In the bad times. That happens when people say, you know, I bought it at 100, it's 50 now, I got to get out or before I lose the other 50, you know, and things will never get better. That was not the case in the 13 years. So we had a hard time accessing bargains, and the funds in that category, for example, had the worst stretch ever. Now, they all earned at least 10, which is not the worst thing in the world, but it was far from our long-term average. Now we think we have a shot at the long-term average again because we think that there will be motivated sellers, forced sellers, and you know that those are the people you want to buy from.
So yeah, that's the end for this part of the video, right? But let's break down a bit of what he's talking about, right? He thinks that there will be a return to the long-term average, which is 22%, right? So for us as investors, there's three takeaways from this, right? That to prepare for, you know, if Howard Marks is correct, to prepare for the oncoming panic sellers or the forced sellers or the motivated sellers, right? So first of all, you have to raise capital, right? Maybe lower down your exposure now and, you know, you can buy back later, right? Because I think we're entering, I tend to agree with him. I think we're entering a period of maybe slower growth, maybe even recessions, and very likely for sellers, right, with all the commercial real estate and banking issues, right? And I don't think we've seen the worst of the banking issues and the commercial real estate issues, right? So second of all, obviously increase your income, because that's only, you can only buy assets with savings and also cash, right? And third of all, obviously compound knowledge, right? Because if you know what to look out for, if you know what he said just now, right? If you know that during the good times, there will be, you know, people who are not scared to lose money and they are only scared to FOMO, right? Basically, they're only scared to miss out. They're only scared. There's easy monetary policy. There's easy access to credit. There are people that are leveraged to the hilt, right? means when the bad times come, they will be the opposite, right? That means they will be scared to lose money. There will be tight monetary policy. There will be hard access to credit. So basically, even if you're a good lender, maybe people don't want to give you credit. And the opposite things will be happening when you want to be buying assets, right? Basically, no complacency. Everyone's scared to lose money. Everyone's panic selling. As he was saying, right? I bought this at 100. It's now 50. I'm scared I will lose this 50, right? Basically, everything is going to zero. The system's going to crash. And that is when you want to be looking to buy assets, right? So yeah, that's about all I wanted to share today. If you did enjoy the video, do help me smash up the like button, hit subscribe, and also hit the bell button. With that being said, have a fantastic day ahead and peace out.